Your financial institution does not possess your funds. I require you to comprehend that before I clarify what is occurring right now. The funds you placed into your checking account, your savings account, your certificate of deposit, the financial institution does not possess it. They loaned it out. They invested it. They utilized it to generate returns for their shareholders. What they maintained on hand is a fraction, a small fraction. And what is occurring right now in the banking system should interest every single American with a financial account. I am going to guide you through the 4 layers of risk sitting on top of your funds right now. Then I am going to demonstrate the 3 moves I am personally making with my own finances to stay protected. And at the end, I am going to demonstrate something most financial advisors will never tell you about: how to structure your accounts to get maximum FDIC coverage. Stay until the end, because that information alone could protect you hundreds of thousands of dollars if the wrong financial institution fails at the wrong time. Let us start with the foundation, because most people have never been told how their financial institution actually works. Layer 1. Fractional reserve banking. When you walk into your financial institution and deposit $100, you probably assume that $100 goes into a vault somewhere with your name on it, that the financial institution is holding your funds for safekeeping, that when you return next week or next month or next year, your $100 will be sitting right where you left it. That is not what happens. Not even close. Under the fractional reserve banking system, your financial institution is legally allowed to lend out the vast majority of your deposit the moment you hand it over. They might keep $3, they might keep 10. The rest goes out the door as mortgage loans, auto loans, business loans, and investments. Your $100 becomes someone else's mortgage payment. And when that person deposits the payment into their financial institution, that institution lends out most of it again, and so on and so on. This is called the money multiplier effect. Your original $100 of deposit can generate $800 or $900 worth of loans across the banking system. The financial institutions profit on the interest from every single one of those loans. You receive a fraction of a percent in your savings account. They receive the spread on everything else. Now, this system has been in place for centuries, and it functions perfectly fine under one condition. That condition is confidence. As long as depositors believe their funds are safe, as long as no one panics, as long as withdrawals happen at a normal pace, the math works. The financial institution always has enough cash on hand to cover the people who walk in on any given day. But when confidence breaks, the system breaks with it, and we do not have to go back to the Great Depression to see this happen. We observed it in 2023. Silicon Valley Bank was the 16th largest financial institution in the United States. $48 billion in deposits walked out the door in a single day. $48 billion in 24 hours. The financial institution had been operating for 40 years. It collapsed in 72 hours. First Republic Bank, over $100 billion in deposits, fled in the first quarter of 2023 alone. The financial institution was seized by regulators and sold to J.P. Morgan Chase, Signature Bank. Same story. Customers lost confidence. They pulled their funds. The financial institution could not cover the withdrawals. It failed. 3 financial institutions over $500 billion in combined assets gone in a matter of weeks. And here's the part that should keep you up at night. In March of 2020, the Federal Reserve made a decision that most Americans never heard about. They eliminated the reserve requirement entirely. Prior to that, financial institutions were required to hold at least 10% of certain deposits in reserve. 10 cents on every dollar. Not a lot, but something. The Federal Reserve dropped that requirement to 0. Financial institutions are no longer required to hold any minimum percentage of your deposits in reserve. None. That policy is still in effect today, right now, as you are watching this video. So, when I tell you your financial institution does not have your funds, I am not exaggerating. I am not being dramatic. I am describing the legal framework under which every financial institution in America currently operates. Layer 2, bail-ins. Now, let me explain what happens when a financial institution actually fails, because this is where most Americans get a very unpleasant surprise. Most people have heard of a bailout. That is what happened in 2008 during the financial crisis. Financial institutions made terrible bets. They lost billions. And the federal government stepped in with $700 billion of taxpayer funds through the Troubled Asset Relief Program, known as TARP, to rescue them. The public was furious. The financial institutions survived. The taxpayers paid the bill. What most Americans have not heard of is a bail-in. A bail-in is the opposite of a bailout. Instead of taxpayer funds rescuing the financial institution from the outside, the institution rescues itself from the inside using your funds. Under the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, if a systemically important financial institution is failing, regulators at the FDIC can place it into a process called orderly liquidation. During that process, the financial institution has the legal authority to convert depositor funds into institutional equity. Let me say that again so it is absolutely clear. The institution can take the cash in your account and convert it into shares of a failing institution. You walk in with a checking account. You walk out with stock in a company that is experiencing difficulties. That is a bail-in. Now, if you think this is theoretical, if you think this has never actually happened, let me take you to Cyprus in 2013. The Bank of Cyprus was failing. The government and European regulators implemented a bail-in depositors with more than 100,000 euros, had 47.5% of their funds above that threshold converted into institutional equity. Nearly half of their funds above the insurance limit was converted overnight. People woke up and nearly half their life savings was gone. Converted into shares of a financial institution that nobody wanted to own, that was not ancient history, that was 13 years ago in a developed Western-aligned economy. And the legal framework that allowed it to happen exists in the United States right now under Dodd-Frank. Now here's the critical detail. Deposits under $250,000 per depositor, per institution, per ownership category are protected by FDIC insurance. If your institution fails and your balance is under that limit, the FDIC steps in and makes you whole, usually within a few business days. That protection is real and it is important, but anything above that $250,000 limit is classified as an unsecured claim against the institution. You are no longer a depositor at that point in the eyes of the law. You are a creditor. You are someone the institution owes funds to, and creditors take losses in a liquidation. Sometimes significant losses. If you have $300,000 in a single checking account at a single institution, $250,000 is protected. The remaining $50,000 is not. It goes into the liquidation process. And in that process, you are not first in line. You are not second. You are not even close to the front. Layer 3, the pecking order. This is the part that should make you aware because when a financial institution fails, there is a strict legal hierarchy that determines who gets paid first from whatever assets remain. And the American depositor is near the bottom. At the very top of that hierarchy are derivative counterparties. These are Wall Street firms and institutional investors holding complex financial instruments. Credit default swaps, interest rate swaps, currency derivatives, collateralized debt obligations. These counterparties have what is called super priority status under the Bankruptcy Abuse Prevention and Consumer Protection Act. They get paid before everyone else, before bondholders, before other creditors, and before depositors. Now, let me give you a number that puts this in perspective. The 5 largest financial institutions in the United States, J.P. Morgan Chase, Bank of America, Citigroup, Goldman Sachs, and Morgan Stanley, collectively hold over $200 trillion in notional derivative contracts. $200 trillion. The entire gross domestic product of the United States is approximately $29 trillion. The derivative exposure of just 5 institutions is nearly 7 times the entire economic output of the country. In a normal environment, most of these derivatives offset each other. They are hedged. The net exposure is a fraction of the notional amount. But in a systemic crisis, when multiple counterparties fail simultaneously, when correlations break down, when the hedges do not work as expected, the gross exposure matters. And that exposure dwarfs everything else on the balance sheet. Below derivative counterparties come secured creditors. These are lenders who hold collateral against their loans. Then come senior bondholders, then unsecured bondholders, then subordinated debt holders, and then at the very bottom come uninsured depositors. Regular people with financial accounts above the FDIC limit. You are last in line. Now let me tell you about the fund that is supposed to protect you, the FDIC's Deposit Insurance Fund. This is the pool of funds the FDIC uses to make depositors whole when a financial institution fails. As of the most recent reporting, that fund holds approximately $128 billion. $128 billion sounds like an enormous amount of funds until you compare it to what it is supposed to cover. Total insured deposits in the United States exceed $10 trillion. The Deposit Insurance Fund covers approximately 1.2% of total insured deposits. 1.2%. If one mid-sized institution fails, the fund can handle it. If 2 or 3 regional institutions fail simultaneously, the fund can probably handle it. But if we experience a systemic crisis where multiple major institutions are in trouble at the same time, the FDIC would need to borrow from the Treasury Department to cover the shortfall. And that borrowing is not automatic. It requires political will. It requires congressional support. It requires decisions made under extreme pressure in the middle of a crisis. I am not saying the FDIC will fail. The FDIC has never failed to protect insured deposits in its entire history since 1933. But I am saying the math is tight, and the cushion is thinner than most people realize. Layer 4, the new rules. And now we arrive at what is happening right now. What prompted me to make this video? Because on March 19th of this year, 2026, the Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency jointly released a new proposal to revise institutional capital requirements under the international framework known as Basel III. Let me explain what Basel III is and why it matters to you. After the 2008 financial crisis, international regulators agreed that institutions needed to hold more capital against their risks. Capital is the cushion that absorbs losses. The more capital an institution holds, the more losses it can absorb before it becomes insolvent. The more losses it can absorb, the less likely it is to fail. The less likely it is to fail, the safer your deposits are. Basel III is the set of international standards that dictates how much capital institutions must hold. It has been debated, revised, and delayed for over a decade. In 2023, U.S. regulators proposed a version called the Basel III Endgame that would have significantly increased capital requirements for the largest institutions. The proposal would have required the biggest institutions to hold substantially more funds in reserve against potential losses. The banking industry responded with the most aggressive lobbying campaign in recent memory. They spent hundreds of millions of dollars. They argued the rules would restrict lending. They said it would hurt consumers. They said it would slow economic growth. They pressured lawmakers. They flooded the comment period with objections, and it worked. The new proposal released on March 19th does not increase capital requirements. It decreases them. The largest institutions, the globally systemically important institutions, will see a 2.4% reduction in required capital. Large regional institutions get a 3% reduction. Smaller institutions under $100 billion in assets get nearly 8% capital relief. Let me translate that into plain English. In the middle of the most volatile global environment in decades, with oil prices surging past $115 a barrel, with the Strait of Hormuz effectively closed with global stock markets experiencing their worst performance since the pandemic. With the United States actively engaged in a military conflict, regulators just told the biggest institutions in America that they can hold less funds against potential losses. Not more, less. The comment period for this proposed rule is open until June 18th, 2026. That is a 90-day public comment window. You can go to regulations.gov and submit your comment. Tell the regulators what you think about reducing institutional capital requirements during a period of extraordinary global instability. Your comment becomes part of the public record. The regulators are legally required to consider it. Now, let me shift from the problems to the solutions, because understanding the risk is only useful if you know what to do about it. Here are the 3 moves I am making right now with my own funds. Move 1. Know your FDIC limits and use every dollar of coverage available to you. FDIC insurance covers $250,000 per depositor, per insured institution, per ownership category. Most people hear $250,000 and think that is the maximum they can protect at a single institution. That is incorrect. The key phrase is per ownership category. Here are the ownership categories recognized by the FDIC: single accounts, joint accounts, revocable trust accounts, irrevocable trust accounts, certain retirement accounts, employee benefit plan accounts, corporation, partnership, and unincorporated association accounts and government accounts. Each of these categories gets its own $250,000 of coverage at the same institution. Let me show you what this means in practice. Say you are married. You have an individual checking account that is covered up to $250,000. Your spouse has an individual checking account that is another $250,000. You have a joint account together that is $250,000 per co-owner. So $500,000 total for the joint account. You have a revocable trust account naming your spouse as beneficiary. That is another $250,000. Your spouse has a revocable trust account naming you as beneficiary. Another $250,000, that is $1.75 million in FDIC coverage at a single institution for one married couple without opening an account at a second institution. If you add payable on death designations with multiple beneficiaries, the coverage expands even further. Each unique beneficiary in a revocable trust or POD account adds another $250,000 in coverage. Go to the FDIC website at fdic.gov and use their electronic deposit insurance estimator. It is free. You enter your account types, your beneficiaries, and your balances, and it calculates your exact coverage. Do this today, not next week. Today. If after structuring your accounts, you still have funds above the FDIC limits, move the excess to a different FDIC-insured institution. The coverage resets at each separate institution. You can spread your deposits across 3 or 4 institutions and have every dollar fully insured. There is no limit to how many institutions you can use. Move 2. Diversify beyond the banking system entirely. This is the move that most financial advisors never discuss because it does not generate commissions for them. United States Treasury securities, Treasury bills, Treasury notes, and Treasury bonds are backed by the full faith and credit of the United States government. They are not held at an institution. They are not subject to bail-in provisions. They are not part of a fractional reserve system. They are direct obligations of the federal government. You can buy Treasury securities directly through treasurydirect.gov. No broker, no middleman, no fees, no commissions. You set up an account, link it to your institution, and purchase Treasury securities directly from the United States government. Short-term Treasury bills, those maturing in 4 weeks to 1 year, are currently yielding over 4%. That is competitive with or better than what most savings accounts and certificates of deposit are paying. And your funds are not sitting on an institution's balance sheet. It is not being lent out. It is not at risk in a bail-in. It is backed by the taxing power of the United States government. For retirees, Treasury securities serve another important function. They are exempt from state and local income taxes. If you live in a state with high income taxes, the after-tax yield on a Treasury bill can be significantly higher than the after-tax yield on an institutional CD paying the same rate. I am not telling you to pull all your funds out of institutions. You need a checking account for daily transactions. You need liquidity for emergencies. But the portion of your savings that you are not using day to day, the portion that is sitting in a savings account earning a fraction of a percent, consider whether that funds would be better protected and better compensated in Treasury securities. Move 3. Conduct a full audit of every account you own. This is the step that takes the most effort but provides the most protection. Pull up every financial account you have, every checking account, every savings account, every certificate of deposit, every money market account, every brokerage account, every retirement account, every annuity, every life insurance policy with cash value, everything. For each account, answer these questions. What institution holds this funds? How much is in the account? What type of insurance protects it? Am I within the coverage limits? and who is listed as the beneficiary. Let me explain why each of those questions matters. What institution holds the funds? You need to know whether your institution is FDIC insured. Most are, but not all. Credit unions are insured by the National Credit Union Administration, the NCUA, not the FDIC. The coverage limit is the same, $250,000, but the insuring entity is different. Make sure you know which one applies to each of your accounts, how much is in the account. You would be surprised how many people do not know their exact balances. Interest accrues, dividends get reinvested, balances creep up over time. An account you opened with $100,000 5 years ago might now hold $260,000. $10,000 of that is uninsured and you might not even know it. What type of insurance protects it? Institutional accounts get FDIC coverage. Credit union accounts get NCUA coverage. Brokerage accounts get SIPC protection, which is different from both. SIPC covers up to $500,000 in securities and $250,000 in cash if your brokerage firm fails. But SIPC does not protect against investment losses. If your stocks drop 50%, SIPC does not help. It only helps if the brokerage firm itself goes under and your assets are missing. Am I within the coverage limits? This is the calculation you need to do for every single institution. Add up all your accounts at each institution by ownership category and compare the total to the FDIC limit. Do the same for credit unions with NCUA limits. Do the same for brokerages with SIPC limits. Who is the beneficiary? This matters for FDIC coverage because beneficiary designations can create additional ownership categories. A payable on death account with 3 named beneficiaries gets $750,000 in coverage at a single institution. $250,000 per beneficiary. If you have not reviewed your beneficiary designations in the last few years, do it now. Life changes. People get married, people get divorced, people pass away. If a named beneficiary is no longer living, that coverage category may no longer apply. Let me give you one more piece of information that most people do not know. If you have a retirement account at an institution, a traditional IRA or Roth IRA held in an institutional CD, for example, that account gets its own $250,000 in FDIC coverage separate from your other accounts at that same institution. But if you have the same retirement account at a brokerage, it falls under SIPC coverage, not FDIC. The type of institution matters as much as the type of account. Here's the bottom line. The banking system is not designed to protect you. It is designed to function. And it functions beautifully when everything is stable, when confidence is high, when markets are calm, when the global economy is predictable. We are not in that environment right now. Oil is surging past $115 a barrel. The Strait of Hormuz is effectively closed. Global shipping is disrupted. Stock markets around the world are falling. The United States is engaged in an active military conflict. And in the middle of all of this, regulators just told the biggest institutions in America that they can hold less capital against their risks, not more. I am not telling you to panic. Panic is never a financial strategy. I am telling you to pay attention. I am telling you to understand where your funds are, how it is protected, and what happens to it if something goes wrong because the rules have changed. The reserve requirements are gone. The capital requirements just got loosened. The bail-in framework is law, and the FDIC insurance fund covers 1.2% of what it is supposed to protect. Knowledge is the only asset that cannot be seized in a bail-in. It cannot be devalued in a crisis. It cannot be lost in an institutional failure. And right now, the most valuable thing you can do with the next 30 minutes of your life is go through your accounts, check your FDIC coverage, and make sure every dollar you have worked your entire life for is protected. If this video helped you understand something about your funds that you did not know before, subscribe to this channel. I break down the financial moves that actually matter. The ones that protect your family and your future, not the ones that make Wall Street richer. Share this video with someone you care about because the institutions are not going to tell them. The regulators are not going to tell them. And by the time the news covers it, it will already be too late to act. I will see you in the next